Well, good evening. This is Mike Murphy with CattleFax, and I'd like to welcome you to the CattleFax Trends Plus Cow-Calf webinar. We appreciate you taking some time out of your evening tonight to listen to us. I think we have some good information that we're going to share with you as we think about today's discussion or this evening's discussion. The first thing that we will be talking about is the cattle and feedstuff market projections as we look in here for the first half of 2018. And we'll even take a glimpse of the calf market as we look in there towards the fall during the full run of calves this coming year. We'll look at just supply projections for both the cattle and the beef industry. Obviously, those will be the driving force of how the market values are influenced. We'll look at and review the outlook of the bred female market. We've got some good information that we'll be able to share with you at that time frame. And then our key sponsor, Elanco Animal Health, with Dr. Mark Hilton, will go ahead and talk through the prevention of neonatal calf diarrhea within cattle as well. So on behalf of myself, Mike Murphy, and Ethan Oberst here on the CattleFax team, again, we appreciate you taking time with us this evening for this information and for the webinar. And as always, we really appreciate the sponsorship from Elanco Animal Health. This has been an ongoing relationship between the two over the course of the last few years, and we feel very fortunate for having them be a part of our discussion here tonight. So as we get into the information relative to the marketplace, we want to start with the discussion on feedstuffs, or specifically we'll talk about the corn market and we'll talk a little bit about the hay market. Fundamentally speaking, as we look at the grain market, we're in a situation where we've got plenty of supply available for usage. As you look at this chart, those blue bars is that stocks to use ratio that we get each month from the USDA, and that's correlated to the right side or the right axis of the graph. And then the blue line, or excuse me, the red line is the monthly average spot corn price, and that's correlated to this left axis. As you can see in the course of the last several years, we're as well supplied as we've been at any point in time. Going back in here during the course of 2014, 15, 16, and through the second half of 17, you can see during that time frame price spent the majority of its window between $3.50 and $4 a bushel. And the current supply environment continues to support that sort of a range in the marketplace. Now, when we look at this fundamentally speaking and we start to look forward here into 2018, as most of us are aware, we've been in a La Nina weather event, and it has been dry through much of that central and southern plains. The forecast from Dr. Art Douglas is that we'll transition back towards more of an El Nino event somewhere later out there into the spring, and that'll certainly bring some moisture through that Midwest area, which is going to be the key regions, obviously, in terms of corn production. So generally speaking, we wouldn't see a significant change to the supply, not only for the remainder of this spring, likely trailing or tracking somewhere between 16 and 17% stocks to use, but even looking further out there into the second half of the year, if Mother Nature cooperates, we should be in pretty good shape there as well. That being said, we know as we were to look at this data historically, as we look at the next set of information here, and what we're measuring here on the right axis is the spot corn futures price. And on the left axis, it's that managed money, also referred to as the commodity funds, overall short position. And as you can see in here, over the course of the last several weeks, the managed money has held a very, very large short position in the futures market, as in record large. More recent, in the last 4 years, there's a correlation if we were to kind of split this chart here and just look at this 2014 area going forward. When the blue line, which is that managed money short position, goes down, the red line price goes up. And it goes up still within the same range that we defined on that previous chart. The practical range is again about $4 to kind of $3.50. You get a little bit of a tail on either end of that, but for the most part, that's the practical range. So fundamentally, we're still in that same range. However, if the managed money decided to liquidate this position and lighten or lessen their exposure of being short the market, we very well could see in the short term here this winter yet where the market on corn would go back towards the high end of the range, which is closer to $4 a bushel. Still staying in that defined range as the fundamentals, because of this adequate supply, suggest during the course of the first half of 2018. And then obviously we'll look to see what Mother Nature does for us in the remainder of the year. As we think about from a big picture standpoint, looking at hay values and hay supplies or hay production, you go in and you look at this. This is annual data. Production for hay is that blue line left axis. The value for alfalfa or other hay, which we would define mostly as being grass hay, is driven off of that right axis. And as you can see, as you look at this information, price, for the most part, has been fairly flat the last several years. And that's reflective as we look at things in here of where we've seen stability, if you will, to production. Obviously, we can point out the drought year of 2012, but since that time frame, we have found more stability to production. We've got adequate supplies from a U.S. standpoint. There's certainly regions of the country that were induced with some drought here this last year that hay supplies got a little bit tight. But overall, we're in pretty good shape. And again, as we transition to more of an El Nino event in the second half of 2018, we will be well equipped to have a solid production of hay crop this year as well. So don't look for any significant changes for either supply or price as we look at 2018, especially in the second half of the year. So let's shift gears a little bit and talk something about where we are from the cattle market in terms of our inventory and supplies. And the first handful of slides here are really fairly basic. You've seen these in the past if you've been with us or seen us at different seminars around the country, and it's just looking at the beef cow inventory. Our projection for the January 1 of 18 will be that beef cows are up about 700,000 head. That report will be issued here on January the 31st, so a week from today, and we'll get confirmation of this number. As you look a little longer term in here, we start to see in our estimation the beef cow herd flatten out. We're running very near what we would define as capacity levels. You know, this 32 to 32.5 million head of beef cows is what you define as capacity. Most of us remember as we came through this era of 2004, 5, 6, 7, 8, that there are certain regions of the country that we actually took grass and turned it into a row crop because that was in that real drive for higher values on the farm sector. So as you lost some of that production, you've lost some of your carrying capacity. So we're nearing the level, and that's one of the key reasons as to why we believe this inventory is going to flatten out here in front of us. How does that translate back? This is looking at the calf crop as a whole. So this would obviously include dairy animals. You can see it's the same shape, right? The 17 calf crop was up about 1.2 million head. The 18 calf crop, as we look forward in here, will be up roughly another close to 1 million head. But then you get in here towards the tail end of the decade, and it again starts to level off. And the primary driver of that is that beef cow herd as we look at things. So as we dial in from a cycle standpoint, this is just important to kind of have this perspective that supplies won't get significantly larger in front of us. And we'll come back to this discussion relative to the calf inventory and really the value of calves as we look in here over the course of the next few years, and just looking at where we're going to have lots of support to that calf market in front of us. But let's dial in a little bit more specific to 2018 and what our expectation is to the marketplace. And we start that discussion really looking at slaughter. This is our steer and heifer slaughter. As you can see, we've got a slaughter number that's on top of 26.5 million head. To get a little bit more descriptive with this, look at things in here relative to our weekly estimates. Okay, and so as you look at this data here, the blue bars are the 2017 actual fed slaughter levels. Those intermittent red bars are obviously holiday weeks as we go back and look at it. The black line with the dots is what we're forecasting, what we've already seen, but forecasting on a weekly basis for the remainder of the year of 2018. And then we've got this black horizontal line, which equates to a 40-hour kill week. And the importance of this discussion in here is twofold. Number one, when you look at where we are from now in through the month of August or into Labor Day, our forecast calls for significant increases of fed slaughter above year-ago levels. Now, you look at that post-Labor Day window into the end of the year, and it's not near significant. But we've got a lot of cattle that we've got to market into this time frame. You know, upwards to about 600,000 head more into the Labor Day period than what we'd have a year ago. That concerns us because we're also, as you can see, killing way above a 40-hour kill week, which implies that the packer is going to have a fairly healthy margin to be able to work through those numbers. So the leverage relationship between cattle feeder and packer processor is still one that we've got to be very cautious with as we look at things in here in 2018, because in our estimation, it's a variable that will be a limiting factor to the market here and also create some of that downside risk. Now, on the positive front, when we look at the marketplace and specifically looking at fed marketings, and that market is exports. You know, very clear cut, right? We saw in 2017, we finally eclipsed to have our biggest export level of our lifetime. And what do we have? We've got growth in 2018, about a 6% increase from an annual standpoint. We actually have about a 10% increase in the first half of the year. Part of that drive, especially here in January and even into February, is South Korea. With the Winter Olympics, we feel like that we're getting a little added bonus for product to be going into South Korea here in the front end of this year of 2018. But this is a bright spot for us. We've continued to be able to grow exports on an annual basis. We recognize that we had a significant setback there in 2015 with the bulk of that occurring there in the third quarter, but we regained our ground in 16, 17, and we expect that to continue on into 18. There's several positives with that. Obviously, I mentioned the South Korea situation with the Olympics, but also looking at the currency. We continue to see where the U.S. dollar is weakening. And that tends to be, it's not a direct correlation, but it's certainly one that tends itself to be supportive to trade from an agriculture standpoint. And as you think about it from the dollar's perspective, we very well could lose more ground to the dollar over the course of the next several weeks, just kind of based on more of a technical outlook when you look at things. So again, a positive out there, no doubt, from a trade situation. The other positive, as we look at things in here in the marketplace, is our actually domestic demand. We've had exceptional domestic demand over the course of the last few years. We still have, because we don't have all the final data for 2017, specifically the trade data for December, but this is a very close number. So when you look at retail demand, which we believe is the purest measurement of demand for the consumer, you can see where we've been in here the last 4 years. We're at the high end of the range. This is very robust demand. We have a lot of positives working for us, and we think that'll continue into 2018. Probably the biggest reason we believe that'll continue on into 2018 is because of the economy. We've got growth in the economy. We can see what this tax reform is doing for many of us as individuals, specifically when you think about the corporate change and what many of these companies, as an example, like Disney, are doing, where they're giving back to their employees. Those are positives to demand, in our opinion. So we look for stable demand in 2018. Now, do we have bigger supplies for 2018 dialed in with that bigger slaughter, even though we have better exports? Yes, we do. So we have an increase in supply on a per capita basis, which obviously means we're adjusting for the larger population, of 1.6 pounds increase. And we're still tweaking a couple things from a weight standpoint. This number could grow to 1.7 pound. It's a big increase is the bottom line. That's what we've got to take note. So we have bigger supply, but we've got a very supportive demand situation, both globally and domestically. And again, it all comes back to economic growth out there in the marketplace. So how does this translate back to value for us? And that's what we want to talk a little bit in here in the next few slides. As we think about value, we still want to be able to refresh our memories of the type of volatility that this market's incurred the last few years, and the likelihood that this is going to continue into 2018. Not to the same degree when you look at the measurement of the first half high to the second half low, where we had a 28% plus correction in each of the last 3 years. But certainly don't be surprised if we come in here and have a 22% correction here in 2018, which is still going to be an awful large break from a historical standpoint. The other things we want to point out with this chart are these blue bars. And you can see what the tendency is, those blue bars, they all exceed or match or exceed a 20% decline. And this starts to help us define our range for the fed cattle market in 2018. Those same blue bars have a recovery, and those recoveries in 9 of those 11 years coming here to be 19 to 25%. Now, you do have a couple years from 2016 to 17, that recovery was 49, and then 40 years prior to that, it was 46. But the target's really that 19 to 25% level when we look at things. So, thinking about some of the key variables that we've laid out for you, right? Number one, we've got an increase of supply, we'll call it 1.6 pounds per capita. We've got retail demand stable, and we've got export demand growing slightly. We're concerned about leverage between cattle feeder and packer. So when it's all said and done with, what's a practical range in the market for us? And a practical range is basically, a 98 to $1 on the low end and $1.30 on the top end. That's the practical range. $1.30 with a 115 average. And the other two things we would tie into this, number one, those analog years I just referred to, when you come off of a second half year low, 19 to 25% from this 104 to 5 area, is going to put you right into a 125 to 131 level. Number two, in the last 27 months, we've only been able to receive in 24 of the 27 months, we've received 22% of the retail price. 22% of a 550 retail is about 121. Add in a $10, $11 drop, and you're right up there around 131 and some change. So this is the defined range for the market. We're obviously, in our opinion, as you look at it, seasonally, we'll find our highs here in the winter, spring, and we'll find our lows out there in the summer, early fall. Now, what about feeder cattle as we start to look at that relationship? And this is a very busy chart, but just bear with me for a minute because I think it'll give you a lot of insight to what we're looking at. What we're implying here is, where do we start the year off for feeder cattle values? Okay, and we're using a CattleFax 750-pound feeder steer price, which for the first week of the year, I'm rounding, was about 153. So you can start to define a range, certainly on the low end. You don't find many years that we're going to be 15% or less, or more, of a break from that 153. That suggests that you're going to have major support as you get into the spring and all the way really into the fall. We're going to have major support right around 130. Yes, there are a couple exceptions to the rules, but in both of those instances of 2015 and 16, we were losing a lot of money feeding cattle. And at least for the first 4 or 5 months of the year, that does not look to be the situation that we're going to be into today. So 130 is on the low end of the range. And then on the high end of the range, especially going into the spring, right? You are very much capped in here right around 10%, which would take you all the way to that mid to upper 160s. We don't think the market's going to get that high. We think this 155 area is the high end of the feeder cattle market as we looked at 2017. So this is your range. And depending on what grain does, we may not test the high end of this range until somewhere out there later on into the year, especially if we start to see grain move a little higher right in front of us. Now, what about calf values? Looking at the calf market, that's the exact same relationship. Where do you start the year off? There's a very strong pattern when you look at the marketplace. We were about 175. Most of us, as we look at the calf market, we're really worried about this fall's calf crop. Yes, there's people looking to buy some stockers this spring, but where are we going to be out there this fall. And again, you look at it and you say a 15% break is a pretty healthy break. That's going to take you right back into the upper 140s. And that's going to account for most all the years, except, again, 15 and 16, which is the red and yellow line. And then the purple line is 1995. I do bring that to our attention because from July 1 of 95 all the way through the second half of the year, corn went up and our cattle feeding profitability went straight down. And so you started to feel the influence of that, of breaking more than that 15% as you got into that fall time frame. I don't personally believe that's a concern for us in 18, but something we've got to keep in mind. And then a little bit longer term in terms of the calf market before we turn things over here to Ethan Obrist and talk about the bred female market. This just gives us a relationship as we look at the left axis. That's just our weekly 550-pound steer price. The right axis is looking at that value as a percent of the all-fresh retail price. And we get a ratio. And really what we're trying to define within this ratio is kind of a range, right? And for the most part, historically, that range is 28 to 38%. Are there some extremes like the high corn of 96 that I just referred to that started on July 1 of 95, or the great financial crisis recession, or that flush out that we had there in the fall of 16? Yes, there's some of those exceptions when something real extreme develops. But for the most part, this is where we are. And what this allows us to understand is that on a practical perspective, if retail prices go back to $5 a pound in the next 2 or 3 years, and we're sitting in here and we're receiving, call it 25% of this ratio, that's a $1.25 steer calf. We've already experienced that, right? That's where we got to in the fall of 16. This is not saying that it's a guarantee that calves won't go back into a new low yet this cycle, but unless demand completely blows up on us, we're not going to go much below that level we've already experienced. So as you think about it from a budget standpoint, at least on the revenue side, I think you can comfortably use 125 as a number at the low end of the range over the course of the next 2 to 6 years as we look at things. So with that, I'm going to go ahead and turn it over to Ethan Obrist, and he's going to walk through some of the bred female information, and then we'll be around and take some questions at the very end.
Thank you, Mike. Hopefully everybody can hear me. And like Mike said at the beginning of the presentation or beginning of the webinar, I appreciate everyone joining us here this evening. Like Mike said, he went through some very good information. I'm going to get into some more of the bred female side, more of the unattached markets here. As we go forward, we're going to look back a little bit, kind of see where we've been. And going forward, we're going to kind of see what the value of these bred females mean, further as we get further on to the expansion or this expansion cycle. So we'll get started here. First thing is we're going to look at the bred cows versus the calf price ratio. What you can see here is on these circles, these are the expansion years, or expansion, increasing cattle numbers, or cow numbers is what I should say. The boxes or the rectangles, those are the years where we go through a contraction period. You can see here there is an overall uptrend to this market. You can see here this has basically been an uptrend, but as you can see, most of these expansion cycles are on the upper end of the range, or we should say the recent range. You can see where we've been here really since the spring of 14. We really started to see this trend higher. And you can see, obviously, 14 and 15 were a lot of this ratio. Why it looks a little bit lower than what you would expect, even though we were in aggressive expansion, it's just due to the fact that calf values were so aggressive during that time frame. And you look at it from a ratio standpoint to bred cows calf values in the fall of 2014 is when we put our highs in, or I should say late fall, early winter of 2014, maintained those levels all the way through 2015. As you can see here, this is some of the most extreme ratios that we've seen in this whole data set, or is the most extreme ratios that we see in this data set. And you actually see, I apologize for a little bit for all my writing here in the way, but you can see here in the last year or so, we've actually seen that price or that ratio increase. As we slow down expansion, that's not necessarily something that we thought we would necessarily see, and we'll get into a little bit of that as we go here. On to the next slide. This is very similar to the first. I won't spend a whole lot of time on this one. This is a bred heifer to fed steer price ratio. A little bit, you can see the ratio, the changes in the expansion and contraction phase here as well. You can see a very similar pattern here in 2017, where we did increase here over the last 12 months. Basically just shows us that female demand has been very good. That's basically what these last two charts have showed us. Demand has been good for females, better than probably what we would have forecasted for basically our going into our fifth year of the expansion. I think if you asked any of us if females would increase in the fifth year expansion, we probably would have said they would have been on the decline. That's obviously not been the case here. So we'll get into a little bit of why that is as we go. Looking here, this is the annual data, so it's basically that same ratio. This is the number of steer calves needed to pay for a bred cow. This is, you can see the long-term ratio, basically a 1.5, 1.5 steer calves to pay for a bred female, bred cow. You can see some of these areas in here are expansion areas here in the early 2000s, the 90s. Obviously not above the long term, but still better or more aggressive, or takes more calves to pay for it than the contemporary years around it or surrounding it, especially liquidation years and the years that tough on agriculture there in the 1980s. I think what we really need to point out and look at here is how aggressive this was here in the last 3 years. We basically put in the three highest ratio years, or taking the largest number of steer calves to pay for a bred cow here in the last 3 years. Like I said before, 2017 was our fourth year of expansion, and how we would count it the fourth year of expansion, and it was the most aggressive ratio that we've ever seen. As we get a little bit further into this, we will start to highlight some of those reasons as to why, and we'll do that here next. But looking at that last graph, or that last chart that I showed, this is basically just laid out in numbers. As Mike alluded to, we really think a lot of this support area, in this 120 area, does provide a lot of support. So this orange area right down through the middle is basically what we would consider a stabilization. The long-term average, roughly at 1.5 times. It takes 1.5 steer calves it takes to buy a bred cow. That would be this orange range. This 1.4 area we would consider more of the liquidation or contraction phase. Then this green area would be obviously the last one we have left is expansion, around that 1.6, as we saw in 2017, 1.75, 1.76, I believe is the exact number. So we did end the year roughly just over 160 a hundredweight, and we did end up with bred cow values for 2017, actually all the way down here. This one, I think the final number was $1,599, or just under $1,600. So as you can see, we're still in that expansion phase, or still in that high demand for bred females. Now going forward, if this does, we do anticipate some softer calf market here in front of us. Our average here for 2018, I believe, is just right here, basically at 158. We'll call it 155 just for easy math, and you can kind of see what that would imply for bred female values of these different types of cattle cycles. Obviously, we're still in expansion, so we're going to be somewhere in this area. We do have a more aggressive bred cow priced in due to some of the things that we've talked about. So just kind of going forward and looking ahead in the future, if our price low does hold at this 120 area, that would suggest basically bred cows getting back into the $950, $1,000 area. That's quite a bit more money to take out of that market as we go forward. Now, do I think we have to get that cheap? You know, a lot of that has to depend on obviously the calf market, and then I would say even more importantly, Mother Nature as we go forward, and just moisture levels and moisture conditions as we go forward. So as we go to the next slide here, we're kind of looking at the factors that influence these bred female prices over the last year. Obviously, one of those is continued expansion. You know, we do not think the expansion is quite done yet. Obviously, it has slowed at a sizable rate, or you know, it has slowed here over the last several years. As we saw in Mike's slide, and we'll repeat that slide as we go forward here. We anticipate basically another 700,000 increase here in a week from today. Now, obviously, USDA can adjust those numbers, but we do think that beef cow herd will approach that 31.9, 32 million mark, somewhere right in there. In the next following years, 2019, 2020, we anticipate basically another 200,000 a year, or kind of somewhere in there. We are basically in that couple 100,000 area range within that 32 million mark. That does seem like a pretty nice number the way everything's sorting out. Is reach capacity. Ranches reach you know, a larger portion of their capacity from a grass standpoint. Also, we do have lost some acreage over the last several years due to corn, due to recreation, due to oil development, some of those things. So some of our ranches' capacities are a little bit less than what they would be in the early 2000s or any time before that. One of the other factors that really influence bred female prices, I don't have to tell anybody this, is stronger than expected calf market. The calf market through the summer video sales was better than 2016. We did anticipate a seasonal calf market heading into, on the cash side of things, heading into the fall. You know, we didn't think we quite had to match those fall lows of 2016, but we did think we'd get back down there in that 130s, 140s area, and, you know, $10, $15 higher than where we were 2016. We did not get anywhere close to that. We rallied through the fall, which is not typical. Once the basis situation in the live cattle switched around, had a rallying fed cattle market as well during that time frame. Obviously, as Mike alluded to, very, very good profits and very good demand on for calves on both the feeder cattle and feed yard side of things. Those two things really, really helped. This is obviously, you know, we did have adequate to ample rainfall. Majority of the beef belt, majority were the cows through the Central Plains. Now, I know that we obviously had dry conditions in the Northern Plains. We've been very dry through this winter, so that is a concern to us. But overall, we did have, you know, adequate rain basically everywhere. Did have ample rainfall, ample moisture through some of the areas in the southeast, through some of the areas in the South. Texas was in some of the best conditions that we've ever seen from a pasture standpoint. So those are the three main factors that really influence these bred females, and one of the reasons why you're seeing such a demand for 2017 for bred females. What Mike alluded to, I don't need to spend much time on this. We anticipate 700,000 head increase, 200,000 over the 2019-2020 area. It might be 100,000, you know, head increments or somewhere along those lines. Basically, rough plus or minus a couple 100,000, that 32 head mark for this expansion is what we're anticipating. As we go forward, highlighting some of those factors, this is basically how we ended up on the calf market. What I did here is break out the difference between the spring cash market for those fall calvers. I did weight that at about 20% of the market. You know, obviously that's a number that's hard to track because you know, spring calvers can sell really anywhere between April through June, and some of those calves, you know, don't get sold until feeder cattle until later that summer, early fall. The other segment that I broke out was summer video sales for fall delivery. You can see I equate about 30% of that market, 30% of the calf market sold through there. And then obviously the main driver, about majority or 50% of the market, was through the fall cash market. I looked at mainly October and November when we sell the majority of our calves through the auction barns, through cash sales, through direct sales, and during that time frame. Here, this is the difference. Difference of $3.27 a hundredweight, not a whole lot of difference in demand for the spring. That's one of the parts, and due to the fact that you know, spring of 2016 was still a decent market. Here in summer video sales, like I alluded to earlier, we're about $14 a hundredweight higher. It was a seller's market all the way through, obviously with, another million more cows calving last year. We thought that was a pretty good market for more additional supplies, a fed cattle market that was going to average lower, a feeder cattle market that was going to average lower as well. And then the real surprise came to us here in the fall market. Obviously, as I said earlier, we did not anticipate seeing a calf market that rallied through the fall. It did, and we basically ended up $40 a hundredweight better than we saw in 2016. A lot of it had to do with the timing of the fed cattle market and just the degree of decline that we saw in the fed cattle market in 2016. Calves we all know that the market got too cheap in 2016. So that comparison is what it is. It is comparing apples to apples, but there was some extracurricular influences there on the 2016 market. So what we basically come up with is a weighted price of we weighed all these out, by the percentages. Come up with a weighted price of $23. Basically, we'll just round up and round down and call it $23 a hundredweight, which equates to, on a 5.5 weight calf, to $128.57, $128.5, $128 a head, better profitability in 2017 relative to 2016. Now that's obviously assuming a flat cash cost. We will see kind of where our cash costs were in our cow-calf survey that is going on, and I will plug our cow-calf survey. If you guys have taken it, I do appreciate it. If you have not completed the cow-calf survey, we do think it's a very valuable information for any cow-calf producer out there. It is available on our website. You can also email me and I can send you the link. If you go to the About page on our CattleFax website, you can find the cow-calf survey there. It's on the left-hand side of the page, and I'll personally thank you for taking that time to do that. And you get a chance to win a free CattleFax membership. So we think that's a pretty good deal for several minutes of your time. Moving on here, the next thing that we kind of wanted to highlight was the weather situation. Each one of these maps is kind of the precipitation as percent of average, or precipitation as percent of normal. This top map is May through July, so really that main growing season for most of the country. A little bit late for the southern plains, probably right on time for the northern plains. You can see these green areas are basically ample moisture, or above. White is normal, and then all the brown areas are below average. So as you can see here, we did start to dry out in the northern plains, some a little bit in the south, but overall we did see normal to a little bit above average in some of these areas. There are a lot of cows in the southeastern plains, or I should say southeast. A lot of cattle in this southern plains, and then obviously North Dakota, South Dakota, and Montana are some of our top producing cow states. So this did influence our expansion. We did have it a little bit more aggressive increase coming into the year. As you can see, the drought in the southern plains, we did back it off a little bit. Now going forward, this is the last 3 months, October through December. We can see more drying out. Obviously, this is a severe area of dry conditions. It's not something that we necessarily want to see, but at the same time, there's not a whole lot of cows in that area. We have to be honest with ourselves. In this area of California, Arizona, Nevada, Utah, there's not a whole lot of cattle out there, but obviously it affects those that are in that area, and we'll have to see. There is still plenty of time for moisture this spring, and hopefully we can get that. Hopefully the forecast that Art has given us, it does show us getting a little bit more moisture in that growing season. Also, another area of concern, really through this main area, consider the beef belt. There's some more drying out. We need to get some more moisture here this spring and early summer for us not to be overly concerned about the pasture conditions and Mother Nature in general going forward. So what this all equates to is we basically have a $1,500 bred cow price pegged in 2018. You can see right here, we have it slightly low, about $100 lower than what we were for 2017. We do feel that we will see a little bit of demand back off. Obviously some concerns over the dry conditions that we could see here develop if we don't get some more moisture here over the next several months. Another concern, and we don't have a large price break factored into the calf market, but if something does change, that is the threats obviously to bred cow prices. Getting into the seasonal here, I just used a typical index here for bred cows. You can see typically get the highest prices here in the spring area. We may see a little bit more of aggressive push up into that if we do get fed prices back in around that 130 area, maybe above. We'll probably see a little bit more of aggressive push. Typical average, low prices down here, larger supplies of bred females coming off of pasture in the fall, and then before increasing there as we go further into winter. What I want to do is get a little bit of forecast here going forward. I want to talk about the net present value. I've written about this in trends before. We've talked about this before in this webinar. I just wanted to give kind of some assumptions to that. This would be the calf prices over the next several years. You can see that we decline here, into 2019, 2020, 2021. Take about $10 out of the average. We could get cheaper than that. I want to be, conservative. On our estimates, obviously as we get out of expansion, do see prices increase over the next several years. One of the other assumptions that we would make is on the net present values is the cull cow values. We do anticipate cull cows decreasing in value over the next several years. Obviously you get more of a liquidation, you have a much larger supply, and obviously put a little more pressure on those markets. And similar to the calves, you start tightening up that supply, more demand for lean meat. You start to see the increase in there. So what that equates to is a net present value. Also in those assumptions is this assumes a cow purchased has seven calves or produces 7 healthy calves for you or for your operation. Also assumes assumes a slightly increasing 1% a year increase to the cow prices, the cash cow prices over the next several years. Basically equates to $50 to $75 a head increase over the next several years. How you read this chart is not necessarily the levels. This doesn't mean that a bred cow purchase in January 1st, 2018 is going to lose $170, but more look at the values, whether they're positive or negative. So right here, a $1,300 bred cow purchase that has 7 calves, like I said, using those assumptions on calf prices and cull cow prices, would show a positive return, here over the course of its productive life. As you saw, we were basically predicting right here in the $1,600 area. It was $1,600 last year. We're predicting $1,500. So using those assumptions, I want to make sure I highlight that using those assumptions, $1,500 bred cow that's purchased for $1,500, shows a negative return. Obviously, we can improve the calf market. She can have one more calf, and that completely changes. But we just want to be aware that there's still some risks to these calf values or these bred cow values, especially if this market changes and/or we see a change in the climate or the moisture here over the next several years. We go a little bit drier period, a little bit tougher to feed that cow, a little bit higher cost, and that $1,500, $1,600 bred cow, turns out to be a little bit less of, good investment than a $1,300 cow would. So just kind of putting that out there is that, there is still some risk to this cow market. Obviously, if we maintain this market above that, let's just call it 125 low, at or above, like Mike alluded to, that we very well could. Cow demand's going to stay strong, and we probably don't have to worry about bred cows getting all that much cheaper. Obviously, the other risk, like I alluded to, is in environmental risk or climate risk there on the moisture side of things. If we do start to see some more drier periods and we start to see a little bit more liquidation and a little bit less demand for bred cows, then you can expect the bred market to be a little bit softer as we go forward. That is all I have here for us. I will introduce Dr. Mark Hilton. He is a technical consultant for Elanco Animal Health. I will turn it over to him. I believe he has some very good information for us and very timely information as we go into calving period here. And we really appreciate Elanco's support, and we really appreciate everything they've done for this webinar series. And I'll turn it over to Dr. Hilton. I will turn it over to you, and hopefully you're with us, Dr. Hilton.
I am. Thank you, Ethan and Mike. I appreciate your your information, and I'm tickled to be here and be part of this program. So thank you so much. I hope my slides are now on. Let me see.
We slides, and it's your opening slide here. So I can hear you.
So I'm good to go. It looks like. Well, thank you.
Yes, sir. You're ready to go. Ready to go.
Super. Again, thanks so much for letting me be part of this. Elanco sure enjoys sponsoring these webinars, and think they're really valuable for the people that are really in the beef business and trying to look at the markets, because it is so important. So I really appreciate being part of this, and Elanco sure likes sponsoring this. So, you know, I've been a veterinarian for 34 years. I've pretty much spent my whole career on helping our producers to prevent disease. I don't like to see disease animals. I like to be an asset on the team with the producer, nutritionist, whoever else is involved in this. So one of the things that I'm really passionate about is talking about preventing neonatal diarrhea. So when I break this down, I try to be really simple on things. And, you know, any of you that heard me speak or write or whatever, you usually know that I'm going to try to be real simple on things and make it the big keys. So there's 3 keys to preventing neonatal calf diarrhea or calf scours. Number 1, and by far the most important, is environment, and just hugely important to have the environment for those calves. And one of the things, there's plenty of research that shows that you need to winter and you need to have heifers separately from cows. Now, I had people say, well, why wintering? Well, if I'm feeding a 900,000 pound bred heifer and a 1,450, 1,500 pound bred cow in the same environment, that heifer actually has more calories than the cow does because she's still growing. If it's in the exact same environment, there's no way that heifer can get the calories that she needs. And that, you know, that environment slips right into my second point of nutrition. Having heifers separately from the cows have been around for years. They've developed immunity to lots of different organisms where these heifers have not. They have not had the breadth of exposure to disease pathogens that the cows have. So if you have heifers and cows in the exact same environment, if they're calving together, you're at 3 times more likely chance of having diarrhea in those calves and having health issues in those calves versus calving the heifers separately from the cows. Next thing I'm going to talk about is nutrition. I'm going to go into it more depth. I want body condition on this cows to be minimum of 5 and actually even better 6. Our cows milk heavier than they did 25 years ago when most of the research was done. And I'd like to see heifers in 6 to 7 body condition score, so they have a healthy calf, produce excellent colostrum, and breed right back. That's fallacy. Some people think that calving heifers in a condition score 7 is going to increase dystocia, and it's absolutely incorrect. So 6 to 7 is great for those heifers. I'm going to talk a little bit about Rumensin at 200 milligrams per day. And then the last thing we're going to talk about is immunology. We want these cows and heifers vaccinated with a scours product, and the Scour Boss. Sure think that's a superior product for many of you to use. So the goal is zero sickness. This calf on the left-hand side, born in the winter, in the snow, and a lot tougher time being healthy versus this calf that's born on the right-hand side, a beautiful spring day with green grass. And like I said, I've been a veterinarian for a long time, 15 years of practice in Iowa, and I had numerous calf heifers that in 15 years never had a calf with scours. Taught at Purdue for 18 years on ambulatory, so I was out on the farm every day, and for 18 years had clients that never had a calf with scours. So if you're a herd that you think, oh, it's just inevitable, I'm going to have calves with scours, that's not correct. And you need to sit down with your herd health veterinarian, your nutritionist, and make a plan, because the goal is zero. Huge fan of the Sandhills calving system. And if you haven't read about this or learned about it, the Sandhills calving system is very different from the traditional way that we were taught to calve for years, where you have a calving lot and all the cows and stay in there, and everybody calves in there for 60, 70, 80 days. that lot becomes severely contaminated, and then all the newborns that are born in that calving lot are immediately exposed to disease pathogens. Versus the Sandhills calving system, where in this picture you see in the yellow box, that's the calving pasture, number one. So we put all of our bred cows, now heifers are somewhere else because we talked about breeding the heifer or calving in a different environment. So all our cows to calve are in calving pasture number one. And what we do is we calve in that calving pasture for about 7 to 14 days. Then, instead of the old way of moving the cow-calf pairs out at about a day or two into a different paddock, what we do is leave all the cow-calf pairs in paddock number one, calving pasture number one, and move all the cows yet to calve and put them into calving pasture number two. And if you think about it, this makes way more sense than the old way that we were, a lot of us were taught to do it, to have a calving pasture and then kick the pairs out. Because again, if we're calving an area for weeks upon end, that is going to get contaminated because those day-old calves are going to pass pathogens and contaminate that area. Whereas in this method, we're allowing every group of cows about every week or so to calve into a clean environment. So you just, like I said, in that first paddock, the 1 to 2 week old pairs stay there. And the cows yet to calve, the bred cows, all move to paddock number two. And they stay there for a week and calve. And you keep doing that until you're completely done calving. As you can see in this slide, after the youngest calves 4 weeks of age, we can commingle them. Because another risk factor for neonatal diarrhea is to have a calf at 4 or 5, 6 weeks of age in with a calf that's a week of age. Because that 5 and 6 week old calf, even though he looks perfectly healthy, can be passing disease organisms in his manure and contaminating that area and getting the young calf sick. I could sit here for hours and tell you stories about clients of mine that I've worked with that have said, "Doc, I'm just not happy. I keep getting calves with scours." And we go in, have them draw up what we think is a reasonable calving paddock system, and a lot of times they don't have 8. Maybe they have 5 or 6. On smaller herds, they don't maybe not need 8. But 100% of the herds that we've helped to start the Sandhills calving system, 100% of them stay with it. And I've got one that I can think of right off the top of my head. We started this about 7 years ago, and they would treat half the calves with scours before we started this program. And in the last 7 years, they haven't treated a single calf for scours. So it really works. It really, really works. And to me, it's the most important thing you can do to prevent neonatal diarrhea in your calves. Nutrition, super important. And I think that every cow-calf producer needs to have a nutrition expert on their team, be it a nutritionist or a feed salesperson, veterinarian, extension educator, somebody that's an expert on nutrition can help you. Picture on the left shows some bred heifers out grazing stockpiled fescue in January in Indiana. Adequate nutrition. Put some free choice salt mineral mix with them, and that's a good ration. Versus on the right, a cornstalk bale that's been sitting under a row of trees for about 3 years. That's bedding. It's not nutrition anymore. One of the things that we sure recommend is feeding Rumensin. It's the only ionophore that's approved for beef cows. And as you can see, the 200 milligram per head per day amount of Rumensin fed saved in this experiment with 415 cows 11% of the feed. So I always say to people, you can either use 10% more feed, or you can feed 2 cents worth of Rumensin and increase your body condition score the exact same way. And as you can see in this study, body condition score, weight change in these cows was the exact same with eating 11% less feed. This shows the economics of feeding Rumensin. So I would say so we're going to feed Rumensin in this trial. It was 112 days, so it costs 2 cents per cow per day to feed Rumensin. So you're going to spend $2.24, and they did this experiment, and they took cows from body condition score 4 to 5. So if hay is costing $90 a ton, like in the middle here, that's a $19 gain from feeding Rumensin. So I always say if you took $2.24 and took it to the bank and put it in the bank, $2.24, and 112 days later come back and say to the banker, how much money do I get? You would have $2.25. Now, if you take that same $2.24 and invest it with your feed dealer in Rumensin, you get back $19. That's about 1,000% return on your investment. So it just seems like a real no-brainer to be feeding Rumensin to cows. If you're feeding feed, gluten, distillers, any kind of feed in a bunk to the cows, they ought to be on Rumensin. Very, very valuable. Helps the body conditions for the cows also. The last thing is immunology. And besides calving heifers separately from the cows, because that helps on the immunology, the Scour Boss 9 vaccination is a great way to help the immunology because you're putting E. coli, rotavirus, coronavirus, Clostridium antigens into the cow. She develops immunity to those through her colostrum. And then as soon as the calf nurses, the calf gets those antibodies and is protected against those pathogens. There was a study that was done and they asked veterinarians if they were happy with Scour Boss, and 97% said they were satisfied or very satisfied with the protection of Scour Boss, even with inclement weather. So the nice thing about the vaccine is you can give the first dose 16 weeks pre-calving, and then give the booster doses 8 to 10 weeks pre-calving. More antigens than any other Scour's vaccine product on the market. Very, very popular product that we see a lot of use out of. So again, I'm going to just wrap up. Environment, that is the key. That is the most important thing. Winter and calve those heifers separately. Use the Sandhills calving system. Nutrition, have the cows in great shape, 5 to 6. Heifers even better, 6 to 7. Make your body condition score easier to get to by feeding Rumensin, and vaccinate those cows and heifers with Scour Boss according to your herd health veterinarian's recommendations. So there's all the legal, and that's all I've got, guys, on the preventing neonatal calf diarrhea. Thanks for letting me share.
Thank you, Dr. Hilden. I will grab the presentation here. Well, looks like we've reached our time limit here. If you have any questions, please feel free to email Mike or I. Our emails are on the screen here. Any questions you have. Also, if you have any questions for Dr. Hilden, we'll be sure to get those forwarded to him and allow him to answer those questions as he's the expert here. So if you have any questions about anything Mike or I presented as well, please feel free to reach out and email us. And thank you for everyone for joining us here this evening. And we look forward to having you join us on the next webinar, which will be around the end of May. So look forward to that, and take care.